Contract for difference, also known as CFDs, is an investment instrument that allows traders to participate in price movements of securities, indices, and even commodities without taking full ownership of the underlying asset. CFDs enables traders to realize profits from falling markets as well as rising markets due to the ability to trade both sides of the market. In this chapter, we will look into some of the benefits of trading CFDs versus physical share trading. CFDs enable investors to leverage an investment up to 20 times under normal conditions based on equities and on share indices. The ability to leverage the investment is a principal benefit of this product. There are a number of reasons why investors and traders choose CFDs over physical shares. In practical terms, investing in stocks through CFDs offer similar profit and loss opportunities as when trading stocks in the traditional manner. One of those items is leverage. It enables the trader to take positions that are larger than his or her initial deposit on their account, and thus being able to trade on smaller market movements. Another benefit is that of short selling, where the investor or trader benefits from falling stock prices. Short positions may even earn interest, although index CFDs do not earn interest. And there's no interest to pay when trading CFDs intraday, as long as they're closed on the same day as they're open. And that makes CFDs a very attractive proposition to intraday traders. What separates CFD trading from share trading? Well, for one, the CFD trader does not have any shareholder rights. There's no voting rights. You can't attend annual general meetings. When you trade CFDs with one broker, it has to be closed with the same broker. Furthermore, CFDs are traded on margin, and you will pay interest to carry a position from one trading day to the next. If you've gone short a CFD, you will receive interest except if it carries a negative interest. Short positions on CFDs will require you to pay the dividend, but if you have a long position in a CFD, you will receive the dividend. The essence of CFD trading are as follows. When you are CFD trading, you are trading at the underlying market prices. When you're trading CFDs, you will pay to enter and exit the market via commission. And finally, you also have the ability to trade the market not only from the long side, but also from the short side, capitalizing from falling prices. When we're talking about leverage, we're really talking about margin, and margin is low. It can be 10% or less. And CFDs is available on stocks, on stock indices, as well as on commodities. Let's take a trading example. Let's say you think a given company will rise from its current share price of £6.10, and you buy 1,000 CFDs at that price. Assume it rises to £7, where you sell your 1,000 CFDs that you purchased earlier. You have now realized a profit of £900, excluding any commissions that are yet to be paid. If you think a given company will fall from its current share price of £6.10, you sell 1,000 CFDs at that particular price and assume that it falls now to £5.50, where you close your CFD position by buying them back. What is your profit? Well, your profit is going to be the difference between where you sold it short and where you bought it back. In this case, you have made £600, excluding any commissions due. Let's take a look at how margin works when we're trading shares on CFDs. Let's say you buy 1,000 CFDs in a given company, which incidentally is the same as buying 1,000 physical shares, thinking that it will rise from its current price of £6.10. Well, if you're buying 1,000 CFDs at £6.10, the value of your investment is £6,100. That's your nominal position. But your margin requirement for this CFD purchase is 10% of the value of your investment. In other words, we will ask you to deposit at least £610 on your trading account in order to control £6,100 worth of position. That is known as the initial margin. Imagine you expect the price in a given investment to fall. Initially you bought 1,000 shares at £6.10, costing you £6,100. Now the shares are trading at £7 and your holding is worth £7,000. So far you've made £900 profit, or a return on investment of 14.75 percentage point. Let's look at what options are available to you. The first option is that you can simply sell your shares to lock in your profit at £7. You will then crystallize a profit of £900. But there is another option, and that is the option of using CFDs to hedge your position. If you go down this route, you will sell short 1,000 CFDs at £7. Imagine then that the shares, as you anticipated, goes back down to say £6.10. You will now sit with a profit on your CFD position because you sold it short at £7. So what you may have lost in unrealized paper profits on your physical position, you will now be compensated by the equivalent profit on your CFD short position. What if though they didn't decline from £7 to £6.10, but what if they rose to £10? How do we stand our position then? Well, on our physical shares, we are long from £6.10, but on our CFD position, in the same share, we are now short at £7. When we are hedging, we are essentially closing the position. Some traders and investors use CFDs to lock in profits on their physical shares without selling the physical shares. You may ask, why would they do that? And there could be several reasons for that. One of those may be that they want to defer their tax liability. CFDs give you the flexibility to speculate in both market directions, both long and short, while with physical shares, you can only go long. Interest is paid or received on the value of your position at the close of the trading day. LIBOR interest rate is used for UK shares, while Euro and US products, we are using Euribor and Fed funds rates. We will charge a small premium over and pay a small premium under. Interest does also apply to the weekends. Let's do a quick overview of what CFDs and CFD trading is all about. Whenever you trade CFDs, you will pay commission, but you will be dealing at market prices when you're trading CFDs. When you're trading CFDs, you're trading on margin or leverage. And when you're trading CFDs, you have the ability to trade not only the long side, but also the short side, capitalizing from falling markets. And finally, when you are trading CFDs, you will receive the dividend if there's a dividend payable. However, if you are short a CFD and there's a dividend payable, you will be liable to pay out the dividend. CFDs are a great addition to the arsenal of the private trader and investor. In particular, the private investor have opportunities to speculate in many different asset classes and create a balanced portfolio of both long and short positions.